Hey, what's going on, team? Bennett Tyndall here, bringing you the subscriber video update. This will be for Monday, December 10th, 2018. Man, we're getting really close to the holidays. So let's go ahead and start it out. Take a look at the newsletter. We do have some interesting, some key economic data coming out on the week. We do have CPI and PPI both out. We've got Tuesday and Wednesday there. We also have retail sales coming out on Friday, which should be interesting in light of the November jobs report that came in under expectations. Now, I talked about that a bit here in the newsletter update. That's really kind of a double-edged sword. In one, it does kind of support the idea that perhaps Fed Chair Jerome Powell can back off the pace of these rate hikes. But on the at the same time, on the flip side, that confirms what the long end of the curve has been telling us, and that is that the U.S. Economic growth is starting to slow. And that's something we've been discussing for quite a while now as a team. Just the fact that the current rate of growth in the U.S. economy is simply unsustainable. And we had the inversion of the 3- and 5-year yields. The 2- and 5-year, I believe, also inverted. And so the long end of the curve is starting to tell us that perhaps this growth is not sustainable, as we've been suspecting. So on one hand, the jobs report does kind of take off a little bit of the weight surrounding the rate hikes, and perhaps that the Federal Reserve can back off just a bit. But as I just said, it then kind of also gives weight to those who are really watching the long end of the curve and the sentiment surrounding what that has been telling investors. So just a whole heck of a lot for the markets to be digesting right now. In fact, let's see, where did it go? Last Monday, the 3rd, I believe it was, yeah, December 3rd. Over the weekend, we got news regarding the U.S. and China, kind of putting a 90-day ceasefire on any additional tariffs or lack of increasing any of the tariffs that are already on the table. And that was reflected in the gap up that we had Sunday evening in the futures market, which is very common of what you would expect during a period of correction. So during a period of correction or a bear market even, stocks go down on most days, and then they go up on days where there's good news or news that is perceived as good. Well, the cash session spoke that day, and it was an interesting range. We had an open 2790, had a high of 2800, had a low of 2773, and we closed at 2790 spot 37. So 13 cents under the close. That was a very flat day. A lot of indecision there out of the markets. They couldn't jockey for a position higher or a position lower, even with the gap over these traditionally utilized technical indicators of the 50-day simple moving average and the 200-day simple moving average. Tuesday, that brought even more selling pressure to the markets. President Donald Trump tweeted out, kind of threatening China, essentially stating if in fact they are unable to come to some sort of an agreement, that they will he'll continue with the additional rate hikes. He has $267 billion worth of goods lined up. He also discussed recently had mentioned the increase from 10 to 25%, as he's been talking about for some time. Investors didn't like that. We had the inversion of the 3- and 5-year yields, and we had a very, very heavy push to the downside on Tuesday with an open of 2782, had a high of 2785, a low of 2697, and a close of 2700 spot 06. We closed right at that 2700 handle. We then had a break. So Wednesday, the markets were closed in remembrance of the 41st President, George H.W. Bush. Donald Trump was at the funeral, and it was essentially a government holiday of sorts. We then had news regarding the U.S. arresting the chief financial officer for Huawei. Forgive me if my pronunciation is off there, but I'm just not sure on that one. Not only is she the CFO, she's also the founder's daughter. So a lot of investors feared that that's going to really have an impact on trade negotiations between the United States and China. And so that was definitely a very bearish catalyst. And in fact, when futures opened back up after the break, we had a huge move to the downside. A very large seller came in. I think there were some 36,000 S&P future contracts liquidated in that first 5-minute candle, and believe it or not, they actually had 10-second volatility halts during that period. I don't remember the last time we had a halt in the U.S. futures market, but then we had a push down on Thursday. But Thursday, we actually had some dip buying coming in here. So we had an open at 26.63 spot 5.1, a high of 26.96 spot 1.5, a low of 26.21 and a close 26.95 spot 9.5. So the markets were all over the place. And you did see some capital infusion into some of the more defensive sectors. We were just looking at, in the newsletter here under the sector review, the fact that the real estate actually caught a bit of a move higher. And with yields falling, home builders, mortgages fall as yields fall. Home builders and lumber producers actually got a nice boost, driving that sector higher. Utilities had a nice push up, now a 1.44% change on the year. It also saw a nice move higher on its overall market cap of that sector. Healthcare was up 16.4%, I believe, last week on a one-year change basis. We did see some profit taking there, but still overall a lot of defensive positioning taking place in the markets. So a very significant shift from the risk on growth in tech stocks and sectors to a little bit more defensive positioning, which we've been talking about for some time. We do see this last final inning of the bull market being more defensively driven in nature. It's not going to be the traditional tech rallies, at least in our opinion, that we've become so accustomed to over the past several years. So just a whole heck of a lot for the markets to digest. And then Friday, the markets pretty much just gave it all back. We had an open there, 26.91 spot 2.6, had a high of 27.08 spot 5.4, a low of 26.2314, and we only closed a few points off of that low, about 10 points off at 26.33 spot 0.8. So we're setting up quite nicely for a continuation lower, which we expect to find some support near the lows from the February 9th 25.32 spot 6.9 level. That does line up with our current Fibonacci projections for the completion of this overall correction. So really just a lot for the markets to be digesting right now. They're not sure what they want to do. As I've mentioned before, we have seen a lot of your traditional dip buying activities, but anybody who bought the dip here or bought the dip here or bought the dip here, they're starting to get a bit nervous. And similar to what we've talked about with Bitcoin, just when the market's going to give it up and we're going to push down to these 25-30 lows and everybody's going to think that it's over, I think that's when the market's going to come ripping back into that primary degree fifth wave breakout. So if you're an investor, you're not sure what to do with your portfolio, it really depends on the lifespan of your investment cycle. So if you're younger, 20s, 30s, 40s, and you still have 20 to 40 years left in your investment lifespan, then perhaps you need to not be as worried as if you were nearing or at retirement and needed the capital that you had currently in the markets. Again, well, I'm not a financial advisor, and this is not financial advice. This is just sort of really what the market's telling us at this point, in that, yes, we do have one final inning left of the bull market. It's going to look a lot different than we have seen. Following that, we are definitely going to be under some very heavy technical pressure, and the completion of this overall cycle in the market does coincide with, as I mentioned before, analysts and economists' expectations of a 2019, early 2020 recession. So it is coming. It's really just a matter of time. It's not a matter of if, but a matter of when. And definitely keep your eyes on the yield curve. Inversion of the yield curve typically precedes the start of a bear market or an economic recession by about a year. So keep that in mind. The 2s and the 10s are very key to watch. I like to watch the 3-month and the 10-year as well. So when you see the news out about the yield curve inverting, well, the 3s and the 5s and the 2s and the 5s have inverted, but the yield curve in its entirety has not. So let me go ahead and bring out this here. So here's a dynamic yield curve courtesy of stockcharts.com. We can go back and look at, you know, the start of the year 2000 sell-off and look at the 2-year compared to the 10-year. Then when we get into the credit crisis sell-off that ended, you know, into 2009, you can see a flattening of the yield curve again. On this move from 2008 to where we are now, very steep positive curve here, and now we're starting to flatten, you know, again. And this is something we've had our eyes on and off over the past, you know, 6 to 9 months. But it's the concerns are valid now more than ever. So keep all of that in mind. Keep that, you know, keep yourself apprised of the headlines. You're gonna see, if you're looking to trade the downside, you're gonna see moves back up. In a bull market, stocks go up pretty much every day, and they go down on bad news or news that is perceived as bad. In a corrective environment or in a bear market, you're going to see stocks go down most days and up very sharply on news that is good or perceived as good. So very, very important to follow the headlines. I don't think that's going to change the overall outcome of this correction, but it can absolutely change the structure and the duration of how this trades out. All right. So yeah, you know, if you're looking to put money to work into some of these lows, I would suggest dollar cost averaging. Don't put all of your eggs in one basket. Focus on diversification, and really just, you know, putting your capital to work in bits and pieces. Okay, don't put it all to work at once. For instance, Apple computers. Apple is down to a nice valuation, and it's nearing what I see as the end of its current corrective cycle. That would be something that perhaps you could, you know, deploy some capital into. I think that will be one of the tech stocks that actually does well throughout the remainder of this market cycle. Last week was relatively slow as far as trades go. Monday or Tuesday we didn't have any trades. Wednesday was closed. Thursday we didn't trade. Friday we did trade. We had some nice profits there in NVIDIA as well as AMD. AMD I did scale out a bit early. Let's see. I started exiting at about 55%, then 60%, then 80%. NVIDIA, on the other hand, I took a position and didn't sell that until about 136%. I think that was my my first and primary exit. AMD ended up seeing, I don't know, 400% profit potential. I think my max exit on AMD was 222%, and my max exit on NVIDIA was 188%. So some nice day trade opportunities there. You know, in the past couple of weeks, we've had 4 or 5 day trades, and they were all profitable. They all turned to profit. So while we are being slightly more cautious, just solely based on and due to the current market environment, we are doing quite well, which not a lot of other teams can say at this point. I do know a lot of professional trading groups that are, you know, have maybe one positive trade out of the past 7 or 8 that they've taken. So it's been a very tricky and difficult market. So keep that in mind. I am hoping to return to our traditional 1 to 3 swing trades per week into this week, if not next. But we're near the end of this correction, and once that's over, then it will be back to business as usual. Looking to get after the S&P short this week, so keep yourselves up to date and keep the alerts active. All right, I think that about does it for just some brief market discussions. Let's take a look. I do have Thinkorswim open, so let's pull up the internals just briefly here. Trend it did have a nice push down. We pushed all the way down to 0.52, and then as the selling pressure came kind of later in the session, we had readings all the way up as high as 2.17. This is more indicative of what you would expect out of this type of a move in the market, and it's hard to get short behind the indexes when you're seeing such light activity based on the internals. and you're seeing more controlled selling. This is more, you know, indicative of capitulation and just kind of fear in the markets. The tick index, we didn't even breach really neg 1,000 for any long period of time, so there wasn't a ton of institutional participation on the downside. Vol spread did come off quite dramatically, and it was an above average volume day, so we are seeing some volume behind this move down, but I see it as more retail traders. I know a lot of you know, Jim Cramer was blaming the algos for this move down, and yeah, absolutely. I mean, certainly there are institutional algos that are trading. Heck, they traded the gap up on Sunday on the news. I mean, they're very well known for trading into news, and traditionally what will happen is you'll get a move on news, so a near-term move higher based on a catalyst, a headline catalyst, that will just eventually give it all back and start pushing lower. So yes, I do think that, you know, the inversion of the 3 and 5 year yields did contribute to Wall Street algos selling into this move. I mean, there's been studies done that some 80% of the market volume is typically made up of institutional algo trading. But I do believe it was the lack of buyers and buying interest that really helped support this move down. So nothing crazy yet. I still think we're about to drop here into this wave 3, which should be the most aggressive decline out of this corrective cycle as of yet. All right, let's go ahead and dive into the technicals, the fun stuff, the meat of it all. Bitcoin, we were looking for that fourth wave triangle completion. It gave us that right at around 4,200 to that 4,400 resistance that we had noted. And now we're starting to push lower. This looks like it could be a fourth wave. Pretty long duration relative to wave 2 of the same degree. So I'm not confident in this count. We were looking for 3,100. We were looking for 3,100. We already got 32.5. So that's pretty darn close to that. Our target, our Fibonacci target, which is a 38.2% overall retracement of the primary degree wave 3's advance. I don't see this as a completed 5-wave move or even a completed diagonal. So I would expect one last push lower. If you're looking to put some capital to work here, what you need to do is you need to wait on a 5-wave move to the upside. That will then create a wave 1 of a higher degree, and then you're going to want to wait for the corresponding 3-wave pullback. So it'll be a nice 5-wave advance, 3-wave pullback, likely to the areas of the previous fourth, or let's see here. 61.8% retracement. Could be shallower. It could be, you know, a 50% retracement. But key there is simply awaiting the corrective structure inside of that wave 2 pullback. Then you can consider going long to the upside. So that's Bitcoin as it stands. That's down there on the 1-hour chart, going up to the daily. We're getting really close to the end of this correction. We also have the previous fourth of one lesser degree at 29.79 spot 88, which should offer some strong support. If we break both of those levels to the downside, we do have an alternate count that perhaps suggests that the end is near for Bitcoin, at least for some time. I don't see it as of yet. It is a possibility. This is, as we've mentioned before, just something to have in our back pockets in the event the crypto market wants to keep pushing lower. All right, over to the S&P 500. Let's just start off here on the weekly chart. So still looking at this as a fourth wave correction of the primary degree, which will square up to this wave 2, which ended back in June of 2016. This completed with a combination or complex correction. So based on the guideline of alternation, it would make sense that this is simply a 535 zigzag. Getting off the weekly down to the daily. Here's our primary count after the September 21st highs. We had a nice 5-wave decline to make up a wave A of the intermediate degree, a little 3-wave pullback in B, which gave us a beautiful 61.8% retracement of this overall post-September 21st high 5-wave decline. And now we're getting ready to drop, or we've already started to drop in C of 4, which will be the last leg lower in this corrective cycle. So the way we see this here on the 195-minute chart, you can see the nice 5-wave progression of A, B, C, to complete B. All of this does decompose properly on smaller time frames. And now we've already gotten a nice wave 1 down, wave 2 counter trend, which gave us a 50% overall retracement of this decline. Something else that was interesting as I was playing around with some fib retracement levels is the fact that not only was this a 50% retracement of this wave 1, this green minor degree wave 1 decline, so a 50% retracement to the upside, it was right at also a 50% retracement of this move here from the lows of A to that high there, the high of B essentially. Okay, so it was a 50% retracement of all of this price action. So got some strong fib resistance there. Let's see, why are you doing this to me, Motive Wave? Can't we just be friends today? Well, we'll just do it this way. I wanted to look at these other levels, but I'm used to doing this on the 34-inch widescreen monitor, so going down to 1920 1080 for the videos can sometimes be tricky. So these are major resistance levels to keep on watch as well. Okay, we closed under the 78.6 of this move, the retracement of that move. So we got to keep it on. Definitely keep those levels on watch. Getting all the way down to the 1 hour, we can get a little bit better of a look. Let's go down to a 30-minute. So following the completion of this B wave back on December 3rd, nice 5-wave move. Wave 5 did push significantly lower than anticipated based on our fib projections, which is, it's not uncommon given what the market has been expressing sentiment-wise as of recent. This wave 2 here looks like a nice combination. Okay, it looks like a 3-3-3 corrective structure. And now it looks like we're pushing lower. It is possible that in fact that was just A of a wave 2 correction, and we're doing 3 up in A, 3 down in B, and now we're starting a little 5-wave move of C. I don't think so. I don't think so. I have this count up just in the event we get a headline that would support a move back up. So again, if we get news that's perceived as good and the market wants to buy into that and rally through it, then perhaps we could look at this as some sort of an expanded wave 2 correction. Either way, that gives us completion of this correction tomorrow. So even if this 5-wave move of C trades out and a move from 2630 back to 2710, which is equality of C and A of the minuet degree inside of this minute wave 2 correction or retracement, is not all that unheard of or uncommon. Bear market and corrective market rallies are traditionally extremely sharp. So keep that in mind, that if we get a move higher, you're going to be looking for resistance there. If we bring in just the 2 versus 1 retracement levels, that coincides and corresponds with rather the 50% 2v1 retracement. More traditional wave 2 retracement levels include the 61.8%, 2 versus 1 up at 2730 spot 54. From a Fibonacci time extension standpoint of wave 2 to 1, traditionally we're looking at a 61.8% Fibonacci time relationship. Equality would put us out towards still into completion on Monday the 10th, and then we get the move lower. Inside of minor degree green wave 3, which should carry us down to 25.3574 at a minimum, which would be equality of 3 and 1. we're gonna do we're gonna have a nice 5-wave move of its own. So if in fact this is not the case, perhaps we're into a little 5-wave move here, and we're gonna get one last push lower, then push higher. But if we just, if internals are supportive of the 2600 break tomorrow, we're going to be looking to short the S&P, probably intraday tomorrow, and with a swing overnight into Tuesday with Wednesday's expiration. So definitely looking for that wave 3 to manifest. I'm excited about this downside potential. And if we get back to the daily, once this 5-wave move completes, actually let's go back here, let's switch over to 195. Once this move completes, it'll be time for a nice rally. So a Santa rally is not out of the question by any stretch of the imagination. And if we look at fib time extensions of wave 4 of the overall primary degree 4th wave to the wave 2 of the same degree, we're right into the area of the 161.8% fib time extension, which is a very common 4th V2 time ratio. Then, if we take it a step further and look at C and A, equality of that would be out at January 24th, but if we look at a C versus B, since this B wave took much longer than it would traditionally take, in fact, let's do a B versus A. So we're past the 61.8 here and approaching equality. So we'll take C versus B on a time extension, and that would put out to, the 19th, December 19th through January 1st. So that's a very appropriate time target and timetable for this correction. If we take it a step further, let's go down to the 1 hour and just look at, based on this wave 1, if wave 2 is complete, a wave 3 would go in towards the 13th, then a wave 4, into the 14th, and then we get this move down towards, December 19th, 20th, 21st. So we could absolutely be setting up for a nice rally higher into the holiday, and then of course into the new year. So don't discount that possibility just yet. Yes, we are tracking the wave count, which suggests, in fact, the top is in, and we're simply entering a new 5-wave decline. It's not out of the question, but I don't see it quite as of yet, okay? I still think we have some strong opportunities in the market. I do think it's going to be a more defensive rally in nature, a little bit more defensively positioned. We're probably going to see some traditional value stocks catch a bid, and that's where you're going to see a lot of your opportunities, I feel. Moving over to the Dow Jones, taking a look at this. So same situation here, looking at this as a 4th wave correction of the primary degree, which squares up to the wave 2 back from June of 2016, leaving room for one last final push in this bull market cycle. Getting down to the daily, a couple ways we can look at this. Down in A, up in B, and then we did a little 1-2 of C, or more than likely this would square up with the S&P, where it was 5 of A, a little 3-wave move of B, and now we're getting the move down into C of 4. Getting off the daily, getting down to the 15-minute chart. Let's start at the 195. You can see this nice 5-wave decline into intermediate degree wave A, 3 up of A, 3 down of B, 5 up of C, very, very clear. And this 5-wave move was kind of my signal that the triangle count was not the count that was in play, and it was just a simple 3-wave flat for that B wave correction. Now we're down into wave 1 and wave 2 of the minor degree, and basically the exact same story as the S&P. It lines up very, very well. Getting all the way down to that 15-minute chart. The wave 2 retraced right at 50% of the wave 1 decline. We were also a 161.8 C versus A extension inside of the correction, although I wouldn't necessarily use that as your guide. You're going to be looking towards the higher degree wave 2 retracement levels. But we're setting up for the same thing here. Completion into perhaps, December 20th, 21st. It all depends on if this wave 2 is complete. If this wave 2 does extend out a bit further, that's going to push all of this out, a few more days in time. The S&P, the Dow, let's take a look at the NASDAQ. NASDAQ, of course, has been under pressure. So you don't have quite as clear as a 5-wave move off of the highs. This looks much more like a 3-wave move, which would make this wave 4 a combination. And basically 3 down of W, 3 up of X, and now we're doing 5 of an ABC correction here inside of Y. And if we look at, let's see here. The only way to square this up and make it a 5-3-5 zigzag is if we turn the move off of the September or October highs here. Let me see something here. Okay, I thought so, but visually that looked confusing for a minute. On if where the high was, if 5 truncated, or if in fact it did set a new high, and it did just barely. But the only way to look at this is a 5-wave move of A is to turn this into a diagonal, an expanding diagonal, which 3 is longer than 1 and 5 is longer than 3. So it is a possibility that it's just 5 down of A, 3 of B, just like the S&P, and we're doing a 5-wave move down of C. But either way, both counts suggest we are heading lower. And retracement levels here gave us just shy of a 50% 2v1 retracement. So the same possibility is also present here as it is for the other indexes, in that we are not quite through with this wave 2. But I would suspect if wave 2 is not complete, we will get completion into early Monday morning. The way to really identify this is to keep your eyes on the flows and keep your eyes on the internals. All right, New York Stock Exchange. This one's been a bit troubling. This one's been a little bit troubling on making sense of this correction while still keeping us bullish. Okay. And the way, let's see, I'm working a revised count here. So we're still working the count, which suggests that the top is in. Okay, and this is just the end of a nice 5-wave cycle, 5-wave move of the cycle degree. But you can also look at this as such, that everything was the same following or up to this cycle degree 4th wave correction. But what's happening following that would be 1-2 of the primary, 1-2 of the intermediate, little 3-4, extended 5th of 3, and now we're into an extended 4th wave correction. The only thing I don't like about this is the time, the 4v2 time extension, which then introduces this possibility that perhaps wave 3 didn't end until January 31st. And that all of wave 3 was this development here. This 4 and 2 doesn't square up very well, but it's certainly a possibility, and that's the other count that I'm tracking. And the reason why this is confusing as opposed to the other markets is we didn't set a new high here in September along with the other indexes. We were never able to retest the January highs established here in the New York Stock Exchange. So perhaps this is, and the reason I introduced this as being a 4th wave of the cycle degree is that would square up better than if this was wave 4 of the primary degree, and that would give us the ability to drop towards about 10,850, you know, basically the 10,000 to 11.2 level, and still remain bullish for that one last final push up in the markets, which we do anticipate. The way this would decompose is with this fourth wave being an overall combination, which based on the guidelines of alternation would square up in that this wave 2 here was an expanded or irregular flat. So getting back to the daily, we'd have 3 down of W, 3 up of W, 3 down of X, and then a simple ABC for Y. And this would work with a diagonal for A, down in B, diagonal for C. Here we've had the bearish cross, often referred to as the death cross by traditional technicians, where you have this shorter term moving average crossing under the longer term moving average. So in this case, the daily 50 simple moving average crossing under the daily 200 simple moving average. If we get down into the 195 minute chart, you could look at this as a 5-wave move. Again, the same argument is valid in that on a longer time frame, such as the daily, perhaps this is a 3-wave move, but I don't see any problems turning this into a 5-wave move. Duration-wise, 4 and 2 would square up just fine. So still expecting further downside here, and this all lines up. All of this lines up for completion kind of into that, you know, the 20th, somewhere in that time frame. So I think the market's going to give us one last final push lower here, test those levels, establish support, and then get back to work on the long side. Okay? So that's it from a macro level. Let's go ahead and dive into some individual stocks and just discuss briefly what I'm seeing. Let's start out with healthcare. Regeneron, man. Regeneron just made a monstrous move. I'm a bit disappointed that I didn't get behind this. We were looking for one last little push lower in this wave 2 correction. I wanted to see a retest of this 327 spot 22 level. But wave 5 truncated, okay? Wave 5 truncated, didn't give us lows beyond that third wave. We knew that there was just a massive move higher brewing for this stock. And sure enough, from 331 back to nearly the 400 handle here at 396. Just an incredible move. Still keeping this on watch for additional upside potential. You can see this nice fourth wave here squaring up to this wave 2 back in 2009. Just a nice 5-wave progression, nice 5-wave subdivision of that cycle degree wave 3. Now we're looking to break higher. Look for support between 354.93 to 362.49 before considering a move into wave number 3. What else in the healthcare I want to talk about? Johnson & Johnson. This one's been tracking really well for us as of recent. We had a nice flat in development here. 3 down in A, 3 up in B. B gave us equality of A, which is indicative of a flat. And now we're looking for that 5-wave move down in C. Getting down to the 1-hour chart. We've been tracking this for quite some time. We've been having some fun with it. I know our subscribers have, independent of our trade alerts. This overall wave C correction should take us, or CF2, should take us back to the 139.89 area. More than likely just a retest of 140 flat. We've already seen a move from 149 back to 142 and a half, or 142 and change. And this looks like a little 1-2, and then we're going to get 3-4, and then 5. That completes the correction. Then you can look for Johnson & Johnson to progress higher. Caterpillar remains a question mark given the current stance of trade negotiations. Initially, this was looking like a nice little 5-wave impulse down in 2. Did hold 61.8% support on the 2v1 retracement. And now it looks like maybe another 1-2. That would make for an awfully deep wave 2 correction here of the minute degree as we approach invalidation. So wouldn't put any capital to work there just yet. All right. Let's talk about staples really quick. Costco's just been a champion for us, holding that fourth wave triangle like there's no tomorrow. Since we had the 3 waves down of A, 3 up of B, we're looking at this going, well, it can't be a flat. We didn't get a full 90% retracement of that decline. So we must be in a triangle. And we laid out these final 3 points of the triangle. We were looking for that move from 217 to 231. The market gave us that. We're already pushing back on our journey down to 219.61. This should complete the wave 4 correction. Then we break out into wave 5. And one thing I've noticed about all of these wave counts across the markets and various assets and sectors is you can see so many of these are supporting the idea that we have one last final move left in this bull market before it's over. Pepsi is starting to push lower. I had to modify the bull count here just a bit. And we do have the possibility that, in fact, we're into an extended fourth wave correction of the cycle degree. I don't care for this alternate count just because that would be a very very long 4v2 time extension. More traditional completions of that fourth wave correction would have been, you know, April 27th, which based on our primary count we completed on May 8th. Even a 1618 extension is June 27th. But it is possible that this is 3 down of A, 3 up of B, and then we're going to get 5 down of C before moving higher into wave 5 of the primary degree. I favor this count, which shows that fourth wave completed back on May 8th, and now we're just in a little 1-2, and now we're in another 1-2, moving higher. We held the 61.8% 2 versus 1 retracement. This is one of those stocks where you don't always get clear divisions of your impulse waves, or you know, the guidelines of alternation in this instance don't always line up, because this looks like a little 1, 2, 3, 4, 5 action. This is a tough call. This is a tough call. 3 is not the shortest. 1 breaks down into a nice 5 wave diagonal. Wave 3, if I get to a smaller time frame, we can break into a 5 wave move. This would call for 2 flats essentially. And now we're into a wave 2 correction of the minor degree. I just don't know yet. I just don't know yet. This is a tough one. So keep your eyes on the 110 to 112.93 levels. But really both counts could play out at this point. All right, what else do we have? Coca-Cola held our fourth wave correction target quite well, held support there, and had some trouble in wave 5. Gotta do some more work on that count, but I'll be sure to update you guys. Apple Computer, man. I mentioned that this strength that we saw when we moved back up to the 180 plus territory, that we're not done with this correction. I'm seeing this as a fourth wave correction of the intermediate degree, squaring up to this wave 2 back from 2016. It is possible that we could demote this 5 wave move and turn it into just simply wave 1 of 3. That would call for or support a move even lower. This count, though, really supports the idea that the markets are going to give us one last final push before we really start ticking lower. This is how I'm seeing the correction in this fourth wave, or a wave 2. They both stand. We had a 3 wave move off the highs. Okay, that's indicative of a correction. That is not an impulse within a correction. A 5 wave, or an impulse, a wave 1 move to the downside, would need to be a clear 5 wave subdivision. This is a 3 wave move. There's no 2 ways about it. You cannot label this as wave 1 and this as wave 2. That's not a 5 wave move. That's a 3 wave move. So that brings in 3 of W, 3 of X, and now we're doing 3 of Y. Of 3 of Y, we had a little AB, and now we're dropping in a 5 wave move of C. I introduced this around 182, suggesting the move down to 155 to 161.85. We already broke the 170 handle, and we've had lows of 168.30. I don't think we're going to have any problems getting down to this 155 to 161 territory. If we break under that, I will defer to this count, which would support a move down to even 144 or 129. That would be a 2 versus 1 retracement of this 5-wave move. It's possible that would give us, you know, from a time standpoint, though, it's not supported based on our market forecast in the indexes. From a time standpoint, this is supported in that this is 4 of the intermediate degree. Okay, 3 was just longer than 1, so we do have 3 being longer than 1. But either way, both counts called for further downside. All right, so that's Apple. AMD, I'm still liking AMD. Still a couple of possibilities here in that we're out of a 5-wave move, 3 waves of B. From a time extension of B and A, B versus A, we're right into what you would expect. And now we could be getting ready for a 5-wave move down in C, but you could also label this, let's get down to the 195, as a completed, I don't have it decomposed here, but I did, a completed 3-wave correction to make up that wave 2. And then we're doing a little 1-2, 1-2. I don't necessarily see it. It's going to really depend on the markets. Semis have been under some pretty substantial pressure as of recently. And this looks more like a 3-wave move than a 5-wave move. So that's what leads me back to this overall count. One thing we need to really keep our eyes on here for any of you long-term investors is if we get off all the way to the weekly chart, here's this combination corrective structure that we're trading in from the year 2000 all the way to 2015. We had a beautiful rally up in 1, very prolonged wave 2 correction. Right at about $13, I identified this Elliott Wave count. We put on a long position with our subscribers, just buying traditional shares. We didn't trade options behind it. I think we capitalized on about 90% return, 86 to 90% return in about a 2.5, 3 month exposure window. The resistance that we ran into this wave 1 of the intermediate degree, that was right off of this extended trend line from this corrective structure. Okay, when we dropped back lower in wave 2, when we corrected in wave 2, we found support off of this horizontal trend line that I've drawn for you. This horizontal trend line acted as resistance during this wave 2 correction. So we've now turned previous resistance into support, and we've got one opportunity left, or another opportunity left, to track higher and retest and hopefully break this longer term price trend and resistance channel. So these are key areas, and a very decisive moment is on the horizon here for AMD. Overall, I like it. I like the fundamentals. I like the financials. I think there's some strong long-term potential there left for AMD. All right, guys, we're getting pretty long in this video. I want to talk about SMH and where we stand with the semiconductor ETF. So we are tracking a count which suggests the top is in, and we'll defer to this if the markets continue to get hammered. But then we've got this count here, which following the credit crisis lows, a nice 5-wave move of the primary degree to make up wave 1 of the cycle degree. Then down in 2, and then another 1, 2, 3, 4, up in 5 to complete 3. That would give us a nice Elliott Wave trend channel from 1 to 3. Then you project a parallel channel from 2 to 4. That would allow this 4th wave to square up to this wave 2 here. Getting off of the weekly down to the daily, it would break down as such, and it's pretty straightforward. I'd look at this 4th wave correction as a combination, a complex, because you clearly have a 3-wave move here. Beautiful triangle for X, so 3 down of W, triangle for X, and now we're doing another WXY in Y of 4. And the reason being is this was clearly a 3-wave move. This looks like a beautiful 3-wave move. 3 down of W, 3 up of X, and now we're dropping in Y. So this would support a move lower which would allow AMD, Nvidia, and some of the others to decline even further. So we got to keep that one on watch. Speaking of the semis, let's see, where'd you go? Nvidia. Getting out to the weekly, we're looking at this as a fourth wave correction of the primary degree to square up to this wave 2 back in November of 2012. Getting off of the weekly, getting down to the daily. Actually, we need to get all the way down to the 1 hour for you to see the 5-wave move. We had a nice little 5-wave move here with a triangle and 4, short and stubby fifth. Then it looks like a nice 3-wave back in B, which gave us just shy of a 50% B versus A retracement. And now we're into some type of a 5-wave movement as I see it. 1, 2, 3, which was a 261.8% 3v1 extension. Very steep fourth wave, but still not invalidating or needing the transition to a diagonal, which would then call for a kind of a recount and evaluation of the substructure. I see this as pushing down in a final fifth wave of C, of 4. All of this lines up with the market. So Apple pushing lower, a big participant in the market advances and a very heavy weighing stock on the discretionary sector. Correction. Let's see here. Where'd you go? XLK. XLY. Sorry about this, guys. Give me just 1 second. Close. Yes. So of the tech, 19.72% of the XLK is Apple. And Amazon is 21% of consumer discretionary. So those are two big stocks that certainly influence. So Apple supporting further downside before the move up. Nvidia supports further downside before the move up. There's a lot of stocks that are in this same kind of territory. And all of this helps confirm our wave counts in the market. So getting back to discretionary and looking at Amazon, still seeing this as a fourth wave correction of the minor degree, which would then allow for one last push before we set into a fourth wave correction of the primary degree. On the weekly chart, pretty straightforward Elliott Wave count here. Super cycle 1, 2, cycle 1, 2. Beautiful 61.8% retracement. Love to see those Fibonacci retracement levels. And now we're into this 5-wave structure of cycle degree wave 3. This fourth wave here, which would square up to this wave 2 here, would follow that one last final push. We're looking at this as inside of intermediate 5. This fourth wave squaring up with this wave 2 here. Okay, that is our alternate. Excuse me, that's our alternate count. That's our alternate count. Our primary count. Scratch everything I just said. Our primary count sees this as the fourth wave correction squaring up to this wave 2 back here, and that would make sense. The only thing I don't like about this count is the size of this fourth wave correction, and in fact I might need to adjust this count to essentially reflect this and just extend the correction. But it is very possible that we are into wave 3 decline of the minor degree, which would be the 5 wave of A of this overall correction. So this count kind of supports the idea that we're going to see a more defensively led final inning of this bull market. So I don't know yet. Both counts would suggest we move lower. Even in this count, I mean, we're not even to a 50% retracement of this advance. This does kind of look like a motive impulse, I believe. Let me take a look. That's a tricky one. This could be a little 5-wave move down. You know, we're doing a little ABC here of this wave 2. Decompose, correction. So, even if the bullish case is in play, we're looking at likely a move back towards 15.5, okay? So this will be decision point, okay? This is one of those cases where we'll wait and see what happens there. If we keep breaking lower, then we can defer back to the primary count, which suggests we have a lot further to drop. Netflix starting to get a move down. Let me take a look at my AMD, Amazon, Baba, Boeing, Facebook, Salesforce, Johnson & Johnson, Google, Netflix, Nvidia. I think that about covers it for this week, guys. Not a whole heck of a lot else that I feel we need to put in front of you. Let's go take a look at the counts that we have in the newsletter before we wrap it up. Talked a little bit about utilities catching a bid. Again, defensive positioning is continuing. The S&P, as of Sunday evening or Saturday evening, or the close of Friday, essentially was only up 0.14% on a one-year basis. Kind of scary. Real estate, talked about that. Financials. So financials have been taking a hit. With the inversion of the 3 and 5, you got to take into consideration that banks make they profit off of borrowing at lower rates on a short-term basis and lending at higher rates on a longer-term basis. So their ability to do that and fulfill certain loans is hindered and severely impacted when you have the type of conditions that we currently have in the economy. So bank stocks are probably going to continue to take a hit. Gold did push higher. We were looking at this, I think, 1220 last week. We breached the 1250 handle, closed the week at 1248 spot 50. Looking at this as a E-wave triangle of a B-wave retracement. So Nvidia highlighted that. Apple, we talked about that. Johnson & Johnson talked about that. Costco talked about that. Regeneron talked about that. And Bitcoin. I think we covered it, guys. That will be it for today. If you have any questions, comments, concerns, feel free to reach out to me directly. You can also go to the website, godeltrades.com, navigate to the bottom, click on contact, fill out the form, and I will get back to you just as soon as possible. Thanks again, as always, for tuning in, and I will see you guys on the next one. Take care. Cheers.